All right, let's talk about picking stocks. How to actually choose an individual company to invest in. We're going to cut through all the noise, forget the confusing jargon, and just break down a really practical way to find companies that are worth your money for the long haul. So let's get right into it. So here it is, the million-dollar question, right? Is there some secret formula, some magic trick that all the pros know for finding a stock before it takes off? It's what everyone dreams of, getting in on the ground floor and riding it all the way to the top. Okay, let's just get this out of the way right now. There is no crystal ball. It just doesn't exist. Anyone who tells you they can perfectly predict what the market's going to do tomorrow, well, they're probably trying to sell you something. There's no secret button you can press that guarantees a win. But, and this is a big but, that doesn't mean it's all just a random guessing game. Not at all. While there's no magic, there is a method, a structured process you can follow to make much smarter, more informed choices, and seriously tip the odds of success in your favor. So, the very first step in this whole method is deciding what kind of investor you actually want to be. When you get down to it, there are really two big different ways of looking at stocks. On one side, you have what's called technical analysis. This is the world of day traders. They're looking at charts, graphs, and patterns, trying to predict where the price will move in the next few hours or days. On the other side, you have fundamental analysis. This is the long-term investor's game. It's all about digging into the health of the actual business, its money, its leaders, its place in the world. For this explainer, we're going down the fundamental analysis path. We're not trying to guess the wiggles on a chart. We're trying to figure out if a company is a solid, well-run business that has a real chance to grow over the next few years. Our first stop, we've got to look at the hard numbers. This is called quantitative analysis. Honestly, you can think of it like doing a quick background check on a company's finances before you get too serious. And this analogy is just perfect. I mean, financial statements can look super intimidating, right? But it's really just like a first date. You wouldn't decide to get married after one coffee. No way! You'd want to know the details first. A company's financial reports, those are just the details you need to know. So the first document we're going to peek at is the balance sheet. The name says it all. It literally balances what a company owns, its assets, against everything it owes, its liabilities. It's basically a financial snapshot. Here's where we stand right now. And from this one sheet, you can do a really simple but powerful little calculation. First, you find the total current assets. That's basically all the cash they have on hand, or things they can turn into cash within a year. Then you find the total current liabilities. That's all the bills they have to pay in the next year. You just divide the assets by the liabilities, and boom, you get what's called the current ratio. It tells you if they can pay their bills. So what's a good number? Well, anything over 1.0 is a good sign. It means the company has more than enough cash to cover all of its short-term debts. Let's take a look at Apple. Their current ratio is 1.4. That means they could pay off every single one of their upcoming bills and still have 40% of that cash left over. Now that's what you call financially healthy. Okay, next up, the income statement. If you've ever heard people talk about the top line and the bottom line, this is where that comes from. The top line is the company's total sales, all the money coming in, that's the revenue. The bottom line is the net income, what's actually left in the bank after every single cost has been paid. And here's another key calculation for us. We want to know how good the company is at its main job. To figure that out, we find the operating income, divide it by the total revenue, and then multiply by 100 to turn it into a percentage. That gives us the operating margin. For this one, it's pretty simple. Bigger is better. A good rule of thumb is to look for companies with a margin over 15%. And Apple, their operating margin is a massive 27%. That tells you they are incredibly good at turning their sales into actual real profit. Okay, so we've looked at the numbers. The company seems financially solid on paper, but that's only half the story. Now we need to look past the spreadsheets and really try to understand the company itself. This part is called qualitative analysis. We're asking different kinds of questions now. Like, how strong is their brand? Is it a name everyone knows, like Coca-Cola? Who's running the show? Do they have a leader with a real vision? And what about the stock price? Is it high because the company's doing great? Or is it just caught up in a bunch of media hype? And maybe most importantly, where is the world going and is this company actually ready for it? Let's dig into that hype factor for a second. There's this classic saying on Wall Street, buy the rumor, sell the news. What it means is that often the speculation of something good happening drives a stock price up. But by the time it becomes official and hits the headlines, the big money has already been made. You want a perfect example of this? The dot-com bubble. Back in the late 90s, the hype around internet companies was just out of control. Everybody was throwing money at any company that had a dot-com in its name, even if it wasn't making any money. It got to the point where people said their hairdresser was giving them stock tips. That was the peak. And then the whole thing burst. It's a huge lesson. Hype alone is not a good reason to invest. So, you've done your homework, you've checked the numbers, you like what you see, and you believe in the company's story. That brings us to the final, and maybe the toughest, question of all. When do you actually do it? When do you pull the trigger? How do you know for sure that you're buying at the absolute perfect moment, right at the bottom before it shoots up? Well, the simple answer is you don't. You never will. Nobody, and I mean nobody, can perfectly time the market every single time. But instead of stressing about trying to predict the future, there's a much simpler strategy that takes all that anxiety away. It's called dollar cost averaging. Here's how it works, and it's actually pretty brilliant. Instead of investing one big chunk of money, you invest a smaller, fixed amount on a regular schedule, say $100 every month. Look at this chart. In month 1, the stock is $200, so your $100 buys you half a share. But in month 2, the price dips to $130. Your same $100 now buys you more of the stock, 0.77 shares. See what happened? Because you bought more when the price was lower, your average cost per share actually went down. You're automatically buying the dips without even trying. So let's pull all of this together. We've talked about choosing your strategy, doing a financial background check, understanding the company's story, and even having a smart plan for when to buy. This is your blueprint. Because in the end, investing in a single company is really an act of belief. The numbers, the quantitative stuff, they tell you if a company is healthy right now. But all that qualitative stuff, the brand, the leaders, the future, that tells you the story of where the company might go tomorrow. So the real final question isn't just, is this a good stock? It's, is this a story I actually believe in for the long run? Answering that for yourself is where it all begins. Thanks for watching.